And you're not worried about a recession in 2026 for the US. You made that clear.
I think it could happen in 2026.
The Bank of England said share price valuations on U.S. stock markets were similar to those seen near the peak of the dot-com bubble. And the risk of a sharp market correction has increased. 12 different CLOs, or collateralized loan obligations. Well, the Bank of England just issued a massive warning on the United States' equity markets because they think what's brewing is so bad that they think if poop hits the fan in the United States, that the United Kingdom is going to have major issues. We're going to talk about that. Keep in mind that people are also now drawing lines on the S&P 500, comparing it back to the Great Depression days, the eras of the early 1930s, suggesting that if the United States were to undergo a Great Depression-style shock, it would just take the S&P 500 down, well, at least on the SPY, down to about 140 or 100, high 130s, which would be about an 80% decline. Now, why are people saying that? Because obviously so much money is circulating around artificial intelligence that it seems like the tangled web of artificial intelligence spending has no shortage of ending. I mean, look at this chart here from the Doomers. It is so confusing. You could see NVIDIA really at the core of everything here, but you see money going to NVIDIA, going from NVIDIA, going to Intel, going to CoreWeave, going from CoreWeave to... It is all this interconnected, tangled web of investment. This comes on top of Musk now raising $20 billion, $7.5 billion in equity, two of that from NVIDIA, and $12.5 billion in debt to go buy a lot more chips for Colossus 3. So at the moment, it's like, man, all this CapEx spend, how could there be anything possibly bad in underlying data? We're going to look at some of these things and how some of this could start breaking down. But understand the money that's being spent right now. First of all, Colossus 1 from Elon Musk in Bluff City XAI data center, 200,000 NVIDIA chips, mostly H100s. Colossus 2, even bigger now in construction, Memphis City, tens of billions of dollars in cost, 300,000 NVIDIA chips. So it's no surprise that you've got Jensen Huang going, oh, Elon, I want everything to do with you, Elon. I love you, Elon. Elon, you are the smartest in the world. Of course Jensen's going to do that because Elon's about to buy 300,000 chips from him. It makes sense. And at the same time, last week, we literally hit the highest inflows to Bitcoin ever. Just a few days ago, we went through the Bank of America flow show where they indicated that we hit the second highest stock market inflow in a week ever. And Bank of America clients have the highest allocation to stocks ever. At the same time as that, we also have a report now that retail in the last month, take a look at this, have bought over $100 billion of U.S. equities, the largest one-month buy on record ever. And so Morgan Stanley is like, look, the reason for this is retail keeps making money. You're working your job, you get income. What do you do with that income, especially as you're trying to grow your portfolio? You go throw it into stocks. And so until there's a jobs recession, there's something like basically not likely to see a slowdown in equity purchases. See, Morgan Stanley says when income slows, that's when we see a slowdown in equity purchases. But otherwise, we're potentially seeing this massive boom right now because the Fed is telegraphing cuts, now obviously because of a very weak labor market, and an explosion of AI deals and news flow. Question is, are those AI deals actually going to turn into any kind of money? And will that all happen before we end up getting real job numbers? Because if we look at private surveys of job numbers, the Wall Street Journal has a great piece where they talk about the unofficial job numbers are in, and it's rough out there. Basically, they refer to analysis by Bank of America, Goldman Sachs, and Carlyle that suggests we're probably at no employment right now. We might be close to very close to zero or maybe even negative employment. Now, of course, that would be bad because, hey, if we're not growing our labor force, that would suggest fewer inflows into stocks because potentially there are fewer buyers here. But then on the flip side, we've got $35 trillion of U.S. equities owned by foreign investors. So does it really matter? I mean, The Economist thinks so. The Economist argues that for every 1 percentage point rise in the share of migrants working in our population, our GDP per person rises 2% in rich countries. So in other words, the more migrants, especially highly skilled migrants you have working in a country, the more your productivity and the more your economic output goes up, which reduces that burden of the national debt. Ken Griffin was on Bloomberg freaking out about how bad the national debt is. Ray Dalio tells us every day how we're going into, the ninth inning of the debt cycle, and this is so unsustainable. Yeah, but so far, so good, because everybody keeps throwing money into the stock market because so far jobs are holding up. Even Jamie Dimon says things so far, so good. And so this is where we start wondering, are there any potential risk factors that are starting to brew under the curtains, so to speak, or under the covers, so to speak, under the hood of the engine? And to some extent, the answer to that is, yeah. Take a look at what Jefferies said, or what they just revealed about a massive loss, billions of dollars of loss, specifically 715 for them, but billions once you incorporate all of the other investors, and how this loss might actually be ubiquitous of some of the underlying risk in our economy. Consider margin debt levels right now are at the highest levels we have ever seen. That's not even counting the advent of leveraged ETFs. Leveraged ETFs use option contracts, and so they don't show up in margin statistics. And therefore, all the money that's in leveraged ETFs isn't actually accounted for in margin debts at all-time highs, which is somewhat scary. Now, does that mean it's time to bail and time to sell NVIDIA stock? Probably not yet. But the early chapters of this bubble popping and the book that's going to be written on this are being written right now. We're going to talk about some of those red flags, especially with this Jefferies deal and what we're seeing with the artificial intelligence space. I want to quickly mention, though, take a look at this on screen here. These were the calls of the last 2 days. So, yesterday and today, these were the calls we made in the Alpha Report. People love these calls so much, they started sending donations in the chat this morning in the live stream going, thank you for this call, and other people saying this. But look at this. Yesterday, I made a call that we would have a down day on Tesla, buy the rumor, sell the news. Tesla was down 4.5% yesterday, straight down from the open. I also made a call, Supermicro, Symbotic, and Figure would go up yesterday, and all of them rallied. Figure at one point up 10%. And then, of course, we got our Oracle news, which did slow down that trade a bit, but it was a great call nonetheless for traders who got in. And of course, we always advocate trailing stops. Today, when the market was in the high 604s, I said, hey, I think the Qs are going to 607 to 609 today. And that Figure would go up. And take a look at this. The Qs this morning, all day long, straight up to 609. And Figure right now is up 9%. Also straight up. So where is this coming from? Well, it's the Meet Kevin Alpha Report. So if you're not part of it yet, use the coupon code Schumer Siesta. I don't have where's my Siesta hat? Use the coupon code Schumer Siesta. We got to work to get some music in here. And join us in the Meet Kevin Alpha Report every single day where I set up trades for the day. Can't guarantee that they're always right. They're definitely not always right, but we do, I think, a really great job, and people are really satisfied with the product and the service, so we keep adding more value to it. You get our fundamental analysis, all 8 courses, could be a tax write-off for you. And we've got more lectures coming out. I'm hoping to post them this weekend, which I'm really excited about. So join us over there. You'll also unlock our stock tab in the Meet Kevin app, which is really cool for course members. So anyway, let's understand what's going on with this Jefferies deal. So when you read this Jefferies article, it's a little complicated to understand what's going on, but it tells you some of the insane risk that's going on in markets today. And it makes you wonder how much of that risk is actually showing up in these AI deals as well. Now, this is considered the largest, what is this? U.S. Banks Credit Union is one of the largest known creditors to bankrupt auto parts company. Fine. So it has to do with auto parts. And we think, well, what does this have to do with AI? What this has to do with AI is banks' willingness to do stupid funding in this economy. This really doesn't have anything to do with auto parts, in my opinion. This is a symptom of the stupid things these companies are willing to do. Look at this. The fund that Jefferies put together carried a leverage ratio of more than 160%, having borrowed against assets to boost returns for investors. And then they told investors that 20% of the portfolio was in hedges, such as credit insurance. In this case, 12 different CLOs, or collateralized loan obligations. I feel like we're literally just playing the 2007 financial crisis on repeat with stupid bank financing, except instead of it showing up in the housing market, it's showing up in private credit, and possibly, we don't know, but I wouldn't be surprised if some of these similar credit deals are showing up in this AI tangled web. Now, let me explain how this insanity works, because it's scary. Take a look at this. So, we're going to look at First Brands. So let's say First Brands has a pile of stuff, mufflers, $100 worth of mufflers. So they ship that right away to Walmart. In this case, Walmart only has about 9% exposure to First Brand products. So even though Walmart seems good for it, over 80% of their products aren't going to big name brands. And when they stop paying, it's a problem. Anyway, let me explain this. First Brand ships $100 worth of mufflers to, let's say, Walmart. Walmart doesn't pay right away. Walmart instead records a $100 account payable. Hey, we'll get back to you in like 90 days or whatever. So they issue an IOU. Then First Brands gets what's called an account receivable on their balance sheet. Well, an account receivable is considered an asset. And with this asset, First Brand now goes to a bank and says, hey, can we borrow money using this bill, this invoice that eventually we hope to get paid on? Can we use this asset over here, this account receivable, as collateral, and can we borrow against it? The banks, being bankers who, want to make loans, say, sure, yeah, we don't care if you want leverage on your flaming pile of crap and trash auto parts. No problem. We'll lend you $160 versus, on maybe your $100 of debt, or however they end up doing the leverage, right? We saw the $1.60 versus of debt for every dollar of actual assets. So we're way over leveraged here, right? But whatever. So the bank ends up having a loan. The bank gets a promise from First Brands that First Brands is going to repay. The bank is like, cool, we now have a flaming pile of doo-doo. What are we going to do with this giant flaming pile of doo-doo? Well, we have an asset, and First Brand pays us a yield, and because we added leverage to it, the yield's going to look even higher. So why don't we put it into some kind of box? And when we put it into a box, we'll call it, Kenoda Capital Fund or whatever. Some kind of like, basically, I feel like if capital is in the name, it almost may as well just say scam. At this point, it was Point Bonita Capital was the name of it. So Point Bonita Capital is a fund that's going to give you access to this flaming pile of crap. And so they're going to sell slices of this flaming pile of crap to individual investors, and the banks are going to hold some of it, blah, 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 blah. And then they're going to hedge 20% of it, which doesn't really matter because the vast majority of it is unhedged, with collateralized loan obligations, which they're going to sell and take fees on from even more unsuspecting investors, because they all hear, oh, but Walmart is the IOU and they're going to be fine, right? Nah, bro, Walmart was only representative of 9.5% of the actual products. O'Reilly, another 8.6%. We don't know what the other 20% was. Could all be junky little companies that just can't pay. And so when people stop paying the receivables to First Brands, because you have like the Tricolor bankruptcy and the auto market goes a little, suffers a little bit of a shock, all of a sudden what happens? How does one bankruptcy like this reverberate? Tricolor goes under, Then First Brands goes under. Then Jeffries is like, ah, crap. Okay, well, we're taking a massive loss, $715 million. Our investors are taking billions of dollars in loss. And on top of that, if we actually go look at now the stock market impact, Jeffries is down 16% in the last, 30 days, probably even more over here. And a lot of this because of the pain of this recent revelation. And you can see a lot of the banks have actually been recovering nicely since Liberation Day. But all of a sudden, people are waking up going, oh, crap, dude, the banks are right back into their stupid, financing strategies from 2008. This is exactly what blew up the bubble of 2008 was bad bank financing that's on rocky foundations, bad fundamentals, and it's fueled by greed. Well, I hate to say it, but I think there's a very real risk that the same greed that we're seeing at companies like Jeffries is in here. We just don't see it yet. Remember, we're not getting the material services agreement yet until November, where NVIDIA, who's an investor in CoreWeave, and CoreWeave buys NVIDIA chips. NVIDIA is promising to lease back $6.3 billion or $6.7 billion of CoreWeave data center assets, but only if CoreWeave can't sell it to anyone else. And CoreWeave is like, yeah, we can't sell it to anyone else. NVIDIA, you're going to have to step in and lease this stuff. NVIDIA is branding it as, it's okay, we'll put it to use. We don't mind leasing it. So, the NVIDIA shills are like, NVIDIA is going to put it to use. Who cares? But people who actually look at this with logic are like, wait, CoreWeave can't lease out all their data centers? Wait, Oracle can't make money on leasing out their data centers? This is bad. These are early warning signs. These two things right here, huge early warning signs in this AI bubble popping. This is why I say I have a hair trigger on my NVIDIA stock. Like again today, I'm up a lot of money on my NVIDIA stock. I love it. I every day this is green, I get happy. I love it. It's just free money, I feel like. I'm sitting here, more money in my face. It's great. But I'm hair trigger ready to sell this sucker because of the warning signs that aren't just showing up in AI, but they're showing up at banks who are financing these deals. This is where we have to be careful because really what's happening is you've got what I call two bubble boys who are blowing money like drunk sailors. Bubble boy number one is Sam Altman, and bubble boy number two is Elon Musk. And they're in like a boyfriend tiff competition with each other to see who could spend more on this stuff. While at the same time, inflows into markets are at all-time highs. And when Jamie Dimon gets asked about a recession in 2026, in a weird way, this was kind of a weird little portion of his interview. Honestly, I should find the clip because I thought it was a little awkward. Jamie Dimon gets asked, hey, could we have a recession in 2026? And he's like nodding his head. Yeah, we could have a recession in 2026. It almost feels like, does he know something? Or does he always say that? Take a look at the clip. Maybe I'm overreading into it. I probably am, but I just thought it was a little eerie.
Way. And so I look, I don't know. I hope for the best, plan for the worst.
And you're not worried about a recession in 2026 for the US. You made that clear.
I think it could happen in 2026. I'm not worried about it as a different statement. We'll deal with it. We'll serve our clients. We'll navigate through it. A lot of us have been through them before. You don't wish it because, certain people get hurt, but it could happen in 2026.
We're still, of course, in the US government shutdown.
But
it's like the most like positive I've seen him. I'm like, have a recession. Yeah. Weird. What is the largest too big to fail bank seeing? I mean, maybe they're getting a little nervous about what's going on in private credit anyway. So how does this all go? Because the Bank of England, they're warning us that markets face a sharp contraction if mood sours on AI or Fed freedom, Bank of England says. Okay, well, global financial markets could tumble if investors' moods sour on the prospects for artificial intelligence or the independence of the Federal Reserve, the Bank of England warned on Wednesday. The Bank of England said share price valuations on U.S. stock markets were similar to those seen near the peak of the dot-com bubble, and the risk of a sharp market correction has increased. And they are now issuing their sharpest warning to date about the dangers of an AI-triggered market slump. Now, when it comes to Morgan Stanley and their take on the valuations, they actually say that, so far, US firms are absorbing tariffs. So unless they exercise greater cost control, weakening the labor market, everything is fine. Notice how everything is fine as long as there's no jobs recession, right? That will continue to be a theme here. And then are valuations justified? Well, if we compare back to 1999 and we factor in EPS growth, yeah, we're actually trading at a discount to the late 1990s levels, says Morgan Stanley. Now, Morgan Stanley, it's like your resident bull in the market right now, but they rely on EPS growth, which makes sense. What could make EPS growth falter? Well, more news like what we're seeing out of CoreWeave and Oracle. If those actually lead earnings to compress, then that's when we don't get EPS growth. That's when we get an EPS collapse. That's when all of a sudden it becomes harder for NVIDIA to keep selling their chips. Now, I think we still have run rate. Elon's still got to buy 300,000 NVIDIA chips. I want to see that money show up. But there's a reason when you look at the Oracle earnings numbers, you can actually see that margins are collapsing 240 basis points. Companies like IBM, we did a great fundamental analysis on them this morning. They're actually playing this AI boom really smart. You could see that analysis in our course member live stream this morning. Which remember, you get all the course member live streams when you're an Alpha Report member. But I think IBM's playing this smart. Oracle, they're eating this hook, line, and sinker. They are very exposed to a collapse of EPS, if some of these circular deals stop coming through. And it's really fascinating because you might wonder, well, Kevin, how does this fear reconcile with the market still going up? And you even saying, oh, the Qs are on a trend to 615 and we're going to go to 607 and 609 today. And then we do. How do we reconcile this? Well, because of this, look what I wrote here, right here. 2 days ago, AMD, massive deal with OpenAI, market up. Yesterday, information, bad news on Oracle margins, market down. Today, NVIDIA XAI deal, market up. That's how it works. Oh, good news, yay. Bad news, oh, good news, yay. And it's just net up. And this continues as long as credit remains available and we don't start seeing the tangled web of shady banking practices unweave themselves. That is the biggest risk. And it's the one we have the least visibility into. Because see, the XAI deal is mostly debt. 12.5 of the $20 billion that XAI is raising, 62.5% debt. So what are the terms of that debt? What happens if XAI continues to lose money? Much like, and there's no profitability, much like OpenAI does. At some point, the spend has to stop. You could even look at the balance sheets of companies like Meta, and they've spent their available cash. Now, they almost need to borrow more to keep the boom going. Actually, I think they had a good piece on Meta in here. Was it in this piece? I can't remember exactly where it was, but there was an argument somewhere that Mark Zuckerberg argues, I'd rather spend hundreds of billions of dollars on artificial intelligence and waste it than risk being late to the AI move. Yikes. Talk about malinvestment. But anyway, what do you have right here? If we get to a point a year from now where we had an AI bubble and it popped, this deal might be one of the early breadcrumbs talking about, these circular arrangements over here with open AI. So kind of crazy, especially when you have Barclays saying FOMO is in full swing and we're lacking a lot of real near-term profitability on AI. Again, for now, hey, keep cranking. Great, we can make money in the markets, we can listen to mariachi bands, but long-term, there are definitely some seeds of concern being planted. So that's where I'm going to leave it for today with the mariachi band, because remember, folks, you can now get lifetime access, potentially tax deductible as well, right off for you. So that's another coupon on a coupon, using coupon code Schumer Siesta.
advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.